Hi everyone. I just came down. As you know, I live around here, and so I thought I would show you the memorial. And in fact, you can see where the ship hit. This is the damage where the ship hit, and back here, it's a boat. It's a yacht, I guess. It's a ship. It's a ship, and it's parked up there. You can't really see it with the sun, but its masts are visibly broken, and this is exactly the point where it hit with. Unfortunately, two kids were killed, 20-year-old, 22-year-old, so it's very sad. All right, it's been busy, and so we've got a lot to get through. We had up here in Brooklyn Heights is where I live, and I live around the corner from Torsten Slok, who's very influential in many ways, strategist and economist on Wall Street. He works for the Apollo Group, which is one of the world's biggest private equity firms. But also he puts out his research for free as a public service, and we had him on our happy hour talking about the economy just last Thursday. So that sort of set the tone, which is this kind of walking on air market that we've got, where guys like Torsten are presenting data which is really bearish across the board. There's almost nothing bullish in the economic data. You're hitting some extreme readings on things like consumer confidence. Credit card delinquencies are rising rapidly. There's a whole list of things basically that are not looking good from a leading indicator point of view. And yet the market has gone up almost in a straight line, really for the past couple of weeks. It's beginning to stall out now, but it's been really interesting because professionals on Wall Street are all extremely bearish, and you've had pretty much a chorus of top commentators, the latest being Jamie Dimon doubling down, CEO of JP Morgan, Steve Cohen doubling down. You've got numerous other hedge fund titans saying that they're expecting us to retest the lows, and basically the market keeps going higher, even after the Moody's downgrade on Sunday, which was better late than never, I guess, but I have no regard for the rating agencies. I always blame them for the global financial crisis because they had one job and they failed. And now for them to be saying that the US government has a debt problem, downgrading from AAA here in 2025 is basically ludicrous. Anyway, it's in the market, and sure enough, the market went up yesterday on the downgrade, so kind of makes my point. Last week we had another interesting thing, which was the Aramco results. People get excited because Aramco has cut its special dividend and is basically, including the enormous dividend, is basically, raising debt in order to pay the dividend to a certain extent. Now, of course, a lot of that break-even type conversation, which is that the IMF will tell you that the Saudis have an $85 oil price break-even. It really misses two key points. One is which the Saudis can clearly cut spending on some of their more crazy projects such as NEOM. But secondly, the Saudis are at a very low debt. And so there's really, to compare Saudi to the US balance sheet is completely ridiculous. I've often asked people, what do you think the oil price break even is for the US government? Because one of our biggest tax generators and biggest economic powerhouses is the oil and gas industry. And that's been a new dynamic over the past 15 years. It was a prior dynamic back in the 40s, 50s, and 60s, until we began to run out of US oil. But the modern day dynamic has been a very powerful US oil and gas industry. Now, what's really interesting this time around is that for the first time in my career, which goes back to 1990, the US oil E&Ps, in my view, are cutting preemptively. They're already in good shape because they aren't overspending greatly. They don't have huge growth targets. They're not wildly exploring globally and drilling dry holes. In fact, they're sticking to their knitting. They're maintaining volumes growing a bit and trying to return as much cash as possible to shareholders while maintaining very strong balance sheets. So already the industry is totally different from what it normally is when we go into down cycles. That's for sure. And secondly, they've already preemptively started cutting capex, even though the oil price has actually held up quite well, I would have said, given the economic sentiment. But of course, the economic reality hasn't fed through yet. And as a result, the oil prices remain quite lively with actually good refining margins, which we always look at refining margins as being absolutely key. Now, there's been some refining outages, but that doesn't change the fact that the US refiners are running at almost all-time high levels. certainly 5-year high levels in terms of refining throughput, which would obviously generate a lot of supply into the market. And yet inventories aren't ballooning and margins are holding up. So that looks ostensibly like what Valero were telling us. We had a conversation with Valero last week, which is that oil demand, as far as they're concerned, and it's always a dubious calculation because they're wholesalers and they're the lowest cost wholesaler, so they're going to sell out. But the reality is, Valero will say they see the market as being perfectly robust with strength in jet fuel. Jet is interesting because we have the single most up-to-date data for the global oil market is the weekly DOE data, which is really the only leading indicator global oil data that we get. And that has been sort of okay, particularly as inventory levels are low. Now, Valero suggested to us, and it's a theory, that inventories have been structurally lower since COVID. Basically, the refiners learned how to run with much less inventory in order to save money and working capital. And what they learned from COVID is that the system needs less working oil capital, less oil in storage than they previously thought. And so they're just running the whole system at a structurally more efficient level, which makes sense. They should get more efficient. And if they bang a bit of AI into their algorithms, I'm sure they can get even more efficient in terms of how low inventories can be. But having said that, prices are doing quite well. So, it's not like we've got low inventories and collapsing prices. We've got low inventories and what look like equilibrium prices. Now, of course, remember this time of year is driving season approach, so you expect oil prices to be lively and normally for them to fall after Labor Day. So we'll see how this one goes. But the general thesis here is that we're in a death by 1,000 cuts type market, not a collapse type market. And so what you're looking at here is, for example, Saudi oil coming back in, but fairly gradually, is going to gradually pressure the oil price lower, and then we'll come out of driving season, and that will take us lower again. And so what you're looking at similarly with the economy is that the tariffs are going to take time to work through. The slowdown on an economy this size with this much juice in it, it's going to take time to get through. And perhaps the most bearish thing of all, in my opinion, regarding the Trump agenda is basically to cut spending. That's just bearish for the economy. I think it's a good thing to do, but I think it's very bearish for the economy. But actually the latest tax cuts suggest that the deficit is going to continue getting worse. And while spending is down somewhat, government spending, and if you look at ultimately the one test that we look at is M2, money supply, those are still all highly elevated. So aramco results are pretty interesting. We then had a dinner with Woodside Petroleum, and I wrote a note about that, meeting the CFO. And it fits nicely with Aramco because Woodside sure enough announced that they're exploring collaboration with Aramco, which presumably will be selling a stake in their US LNG export project, which they just made a final investment decision on. That's Driftwood, which is the project that was originally developed by Tellurian, Sharif Suki, who founded Cheniere, and then basically went bankrupt and was taken over by Woodside. So Woodside are getting into global LNG, and we took a look at an asset base of Woodside, which we described as looking like a meteor trail. It sort of starts in Mexico, goes over the Gulf of America, if you want, and then through Senegal, through Australia, Northwest Shelf Australia, which is by far their biggest asset in LNG particularly, and then ends in the Bass Strait, which is the former BHP assets that are totally mature and have a $5 billion decommissioning cost associated with them. That's the combination of Woodside and BHP Petroleum that we look at today. It's pretty lame, to be honest with you. Our overall conclusion is that Woodside is fairly valued. But you can't help look at Woodside and not think, actually, some of these US oil companies are really cheap. And even if we're all waiting for us to go into a valley of low oil prices, I think most investors are looking for us to have a triumphant mountain climb after that valley, because once we put the US oil and gas production side into decline, it will probably keep declining. And once that decline starts, it won't be long before the oil market gets really tight, and things like all the geopolitical risks that we now talk about that doesn't excite the market because of the spare capacity in the market. Once we have no spare capacity, oil could get super lively. So I would say it's the old Wall Street sell-side classic. I'm incredibly bullish long-term, but expecting a pullback, which I always used to joke is the call you have to make in order to never be wrong on Wall Street. Okay, with thoughts for those young Mexican sailors, I'll leave it there. Have a great week.